Imagine waking up to headlines like global markets in freefall, bond crash unprecedented since the 1970s. Even central banks are dumping U.S. treasuries. This is not science fiction. It's the risk outlined by the Bank for International Settlements, the Bank of Central Banks, in a stunning new warning. U.S. tariffs, they argue, could be the detonator of a global financial crisis. Not a trade war, but a financial earthquake. One that threatens your savings, your job, and the fragile trust at the core of the modern economy. This is the story of how it could all unravel, and why this time, the warning should not be ignored. Chapter 1. The core threat. Let's start with the central idea. U.S. tariffs aren't just a geopolitical weapon. According to the BIS, they are a financial bomb, capable of igniting systemic collapse. In a chilling simulation dated April 9, 2025, the U.S. imposes massive tariffs on 60 countries overnight. The fallout? Nikkei down 4%, Shanghai off 5.8%, oil plunges under $60. Even more alarming, stocks, bonds, and the U.S. dollar all fall together. For the first time in decades, this is the bedrock of the global financial system shaking violently. But how does something as bureaucratic as a tariff explode into global chaos? Let's unpack the mechanism. Chapter 2. The mechanism of collapse. The BIS calls it a stagflationary chain reaction. Trade shrinks, inflation rises, growth stalls. Bond yields rise, values plummet, confidence evaporates. It's not just about prices. It's about trust in U.S. treasuries, in the dollar, in the stability of financial order. In the simulation, U.S. 10-year yields jump to 4.5%. The dollar drops 10% in 6 months, the worst in nearly 50 years. Foreign central banks begin offloading U.S. bonds. This isn't a market correction. It's a loss of faith in the world's safest asset class. And that loss of faith spreads like wildfire, straight to Europe and to your own pocket. Chapter 3. The domino effect on Europe and you. What happens next? Europe may enjoy a short-lived bonus, cheaper borrowing, and a stronger euro, but that's a poison gift. A strong euro hurts exports, from Airbus to luxury goods, and the global recession that follows hits Europe head-on. Shrinking orders, slashed investments, layoffs, credit crunch. Now look at your own savings, retirement funds, life insurance. Many are stuffed with U.S. treasuries, assumed to be safer than gold. But in this scenario, value collapses quietly, and your capital erodes without you taking a single risky decision. And that's not the end. Because the world is now in a financial system that no longer has reliable anchors. Chapter 4. Why this time really is different. This time it's different is often the slogan of bubbles. But the BIS argues, this time it may actually be true. Because global debt is at record highs. Central banks have never printed this much money. Financial interconnections are deeper than ever. And the navigation tools, obsolete. You can't rely on yesterday's rules in a system built on unprecedented complexity. So what can you do? The BIS suggests, diversify, not for profit, but for survival. Invest across regions, asset types, and currencies. Keep liquidity to seize opportunities in chaos. And perhaps the greatest irony, the spark came from a move designed to protect America. Chapter 5. The final irony and a fragile trust. The very tariffs meant to defend the American economy could undermine its foundation. It's like trying to put out a fire with gasoline. As trust erodes in the dollar system, nations seek alternatives. Payment systems multiply. Regional alliances strengthen. The multipolar world the U.S. feared, it's being built by its own hand. Because ultimately, the modern economy doesn't run on dollars, bonds, or oil. It runs on trust, fragile, invisible, and irreplaceable. And once broken, trust is infinitely harder to rebuild than to destroy. If you found this breakdown insightful, don't forget to like, share, subscribe to the channel for more explainers on the macro forces shaping your financial world. Stay informed, stay ahead.